Hey guys, welcome back to another video. Well, it's the end of the week, which means it's market update time. And this week there are some positive signals pretty much all around, which is nice. So let's chat about capacity, volumes, rejections, diesel prices, and then we'll look at spot market conditions and the best places to be for dry vans, reefers, and flatbeds. Ready? Let's go! All right, as always, we're going to start with capacity week over week. And as of last Friday, we lost an additional 220 carriers net. Now, if we look at the general freight volume, again, we're comparing the white line, which is now compared to 2023, which is the blue line. We can see that volumes are staying above those 2023 levels, which is amazing. They are going down slightly right now, but we'll see what happens next week. The question is, what is happening with those rejections? And I have some good news for you. So this is our rejection map. The white line is us in 2024. The blue is 2023. Number one, way above 2023 levels. Number two, look at how rejections have been climbing. Is it possible that this is a continuation of last week, the fact that it was DOT inspection week? Yeah, absolutely. But we can celebrate for now, right? Now, currently rejections are at 4.67%. Still low, but much better than it was like 2-3 weeks ago. And as a reminder, for those of you who don't know, we want rejection rates to be as high as possible because when contract carriers reject those loads, that means that volume gets to the spot market and kind of flips the load to truck ratio to the carrier's benefit. All right, then we have diesel prices, which has been a source of good news for a while now. They have been going down, those diesel prices. And on a national average, we're seeing an average of $3.93 per gallon. And it's continuing to go down. Fingers crossed that it's not going to stop going down. All right, now let's talk about specifics, starting with dry vans on the spot market. All of this data is based on FTR Intel. And because you guys like these tables more than the charts, I am here to deliver. So, rate per mile for the dry van on the spot market on average last week was $1.87. This week, $1.94, an increase of 8 cents per mile, which is nice. Again, might be a byproduct of this DOT inspection week, but still. Rates year over year, if we're comparing this week to the same time last year, are down 3%. Over 5 years, down 8%. Not surprising. Volumes week over week actually increased by 20.6%. So this is really nice. Now, year over year, volumes are down 6% and over 5 years down 19%. Again, not really surprising for dry vans. All right, now we want to figure out what are the better markets for dry vans. And for that, we're going to look at the general market by looking at the rejections, the highest rejection markets, and the highest volume markets. And then we'll put those two together. So let's start with the volume. On the volume side, the most volume for dry vans in general is coming out of Fort Worth, Texas, followed by Detroit, Michigan, then Atlanta, Georgia, Ontario, California, and finally Los Angeles, California. Doesn't mean that these states are the best to be in, but it just gives you an idea of where the volume is coming from. Now let's take a look at rejections. So on the rejection side, the highest rejections are North Platte, Nebraska, which is at 14.88%, looking at my computer right there. Then we have Cedar Rapids, Iowa, 14.63%. Then we have Roanoke, Virginia, that is at 12.52%. Then we have Dubuque, Iowa, which is 11.81%. And finally, Omaha, Nebraska, which is 11.75% rejection. Again, this does not mean that these are the best markets to end up in. What we need is to pair the volumes and rejections to make sure that the most volume goes to the spot market, right? Now, these market areas are, number one, Atlanta, Georgia. This is where a lot of loads go from the contract to the spot market. Number two, Ontario, California, followed by Los Angeles, California. Number 4 is Fort Worth, Texas, or Dallas, Texas, that area. And number 5 is Houston, Texas. All right, now it's time to talk about reefers on the spot market. Rate per mile last week on average was $2.34. This week, $2.47, an increase of 13 cents per mile. Now, rate year over year is actually down 2%, and over 5 years is down 3%. It's actually much less than I expected over 5 years. Volumes week over week are up 24.2% for reefers, and reefers have been having an issue with volume on the spot market from what I saw, so this is nice. Now, year over year, they're down 13%, and over 5 years, down 25%. The question is, where are the better areas to end up in if you have a reefer? All right, same concept, same two maps, rejections and volumes. Let's start with the volume map. The highest volume for reefers is coming out of Joplin, Missouri in the general market, followed by Allentown, Pennsylvania, Lakeland, Florida, Ontario, California, and then Joliet, Illinois. Now, these are the areas that have those freight volumes, right? The question is, where are the rejections the highest? Let's take a look. Number 1, we have Ontario, California, followed by Los Angeles, California. They're both at 27% rejection, so pretty good. Then we have Fargo, North Dakota, 26.42% rejection. Then we have Little Rock, Arkansas, which is at 24.75% rejection. And finally, Quincy, Illinois, which is at 20.33% rejection. Now, putting these two together gives us an idea of where the better markets are because more volume is hitting the spot market. Number 1 is Ontario, California. Number 2 is Los Angeles, California. Number 3 is Joplin, Missouri, followed by Fresno, California, and finally, Fort Worth, Texas. All right, last but not least, we have our flatbeds. Rate per mile last week was $2.43, and this week is $2.45 on average, which is an increase of 2 cents week over week. Now, year over year and over the past 5 years, rates are down 6% for flatbeds. Now, volumes week over week for flatbeds also increased on the spot market by 5.3%. Year over year, however, it's down 3%. Over 5 years, down 30% for flatbeds. Now, again, as a reminder, unfortunately, I do not have those fancy maps for flatbeds because there's no data for them, but I make my own using TruckStop. So let's take a look first at where the load volume is. This is by states, not by market areas, but it gives you an idea. So as always, nothing really changed here. The darker an area, the more loads there are. And of course, all the loads are in the south and the Midwest, maybe some in the Northeast. The least amount of loads are in the plain states, of course. Now, what about capacity? Well, capacity follows the load volumes pretty much. A lot of capacity in Texas, Georgia, Florida, a lot of it in the Midwest and the Northeast, as well as California. Not so much capacity in the Pacific Northwest, as well as some of the plain states. Although you can see there is a good amount of capacity in Utah, Colorado, Arizona, and New Mexico, despite the fact that there are not as many loads there. And usually this is because it pays really well to go to these areas. It's just really hard to get out. Like we, for example, had to deadhead from Utah to Nevada to grab our next load because Utah rates are absolutely horrific. But now let's take a look at the load to truck ratios. Where are there more loads than trucks, meaning more negotiating power? All right, red means there is less than a load per truck. Over capacity, not surprising. We have seen that the market is mostly red. This beige color is about 1 load per truck, and this green is over 4 loads per truck, not over 3, over 4 loads per truck. There are no market areas where there are around 2 loads per truck. So Arkansas, Louisiana, Mississippi, and Alabama, these are the places where you're going to have negotiating power if you have a flatbed. Now, Texas, Oklahoma, Georgia, South Carolina, and these beige states, these are the markets where there is about a load per truck, but you might have some negotiating power if you're looking to go to an area that most people don't want to go. Everything else is pretty much a hit or miss. All right, to sum it up, there is definitely a lot of positive movement this week, and perhaps it's due to the fact that last week was DOT inspection week, but still we can celebrate. Capacity is continuing to leave, at least from what we see when we look at the amount of active carriers, active MC numbers. Rejections are continuing to go up. Thank all that is holy. Diesel prices are continuing their downward slide. And on the spot market side, we saw that all three equipment types saw an increase in those spot rates. But again, it might be because of the fact that last week there was a nice amount of capacity that left the market or didn't work that week because of the DOT inspections. The question now is, will this trend hold, and what is next? Because realistically, we are at produce season's door, and certain markets will start seeing more movement, like for example, California, especially Southern California, for reefers. The issue that I am seeing, and I'm sure a lot of you guys are seeing, is the fact that there are certain markets for each of these equipment types that are manageable, which is fantastic, but it's lacking consistency. There are predominantly those challenging markets all around, and trying to get to that 1 or 2 or 3 good markets can be quite difficult sometimes. Nevertheless, I am grateful for the fact that there are some positive signs this week. Anyway, guys, wishing you an amazing rest of your week and weekend. Stay safe, stay healthy, and keep learning. See you in the next video.